Assalamualaikum warahmatullahi wabarakatuh. We are from Group 3 and we will present Financial Ratio Analysis between Kemuda Berhad and EcoWork Foundation. Our group consists of 5 members. The first one is NURSARAH Hanis binti ROSLI, metric number 1212821. Hanis AFIQAH binti Hasmidi, metric number 1212826. NAUFAL bin AHMAD HAFIZAN, metric number 1213009. SITI ZAFIRAH binti KEMAROLZAMAN, metric number 1222582. SETIOWATI PUTRI LESTARI 1220001.
So we will talk about Eco World backgrounds. So Eco World Development Group Berhad is a prominent property development company in Malaysia with a substantial land bank of approximately 8,318.3 acres, strategically operating across key regions such as the Klang Valley, Iskandar, Malaysia and Penang. Eco World is well positioned in the country's vibrant real estate market. The company has a diverse portfolio of 20 unique projects catering to various consumer preference and market segments. This includes residential projects like Eco Sanctuary and Eco Majestic, commercial ventures such as Eco Business Parks 2 and 1, and mixed-use developments like Ecotropics. EcoWorld is committed to sustainability, integrating eco-friendly features into its developments, as seen in projects like Eco-Forests and Eco-Meadows. Moreover, EcoWorld has expanded its reach globally with operations in the UK and Australia, demonstrating its capability to deliver top-notch real estate projects on an international scale. Supported by its subsidiaries, the company continues to grow and succeed, contributing significantly to real estate industry both locally and globally. Kemuda Berhad was incorporated as private limited company on October 6, 1976 in Ipoh, Perak and listed on the main board of Bursa Malaysia on August 10, 1992. Founded by Kun Yulin and Lin Yulin, Kemuda Berhad is a Malaysia-based investment holding company with a diverse portfolio in civil engineering, infrastructure and township developments. The company operates through 3 primary segments. First, the engineering and construction segment, which handles large-scale infrastructure projects like highways, bridges, airfield facilities, railways, tunnels, water treatment plants, and dams, demonstrating broad expertise in connectivity and water resource management. Second, the property development and club operation segment focus on developing residential and commercial properties, townships, and commercial hubs, while also incorporating club operation to enhance lifestyle options. This segment employs an integrated approach, managing quarries, producing permits, offering project delivery service, and supplying materials for road surfacing. Lastly, the highway segment is dedicated to building and maintaining highways crucial for the efficient flow of people and goods, thus promoting connectivity and economic growth. Kemuda's IT service provide advanced project management solutions, complementing their highway construction's expertise. The company has been involved in numerous significant projects, both locally and internationally. Notable projects include the Kuantan Bridge, Sitra Causeway Bridge, Pulau Bunting Bridge, Hamad International Airport, and the Sungai Selangor Dam, showcasing its proficiency in complex engineering tasks. In summary, Kemuda Berhad's diverse operations and significant projects highlight its comprehensive expertise and substantial contribution to Malaysia's development and beyond. So that's for both background company.
Next, we move to financial ratio analysis calculation. Number 1 is liquidity. There is 2 ways to find liquidity. The first one is current ratio and the other one is asset test ratio. Current ratio measures the company ability to cover its short-term obligation with all of its current assets. From the above calculation, it shows that both current ratio for EcoWork and Kemuda are higher than the industry average. This indicates that both companies will be able to pay their debt on time. But the current ratio for Kemuda is higher than EcoWork. Kemuda having a ratio of 1.88 times means for every RM ringgit of their current liabilities, the company had RM 1 ringgit 0.828 of current asset as a backup, as compared with the industry average, which is 1.52 times. Hence, we can say that Gamuda Berhad has higher liquidity than EcoWorld. Since the higher the liquidity, the easier it is for the company to pay its creditor on time. So, the difference between current ratio and asset test ratio is asset test ratio provide a stricter measure of liquidity by excluding inventory and other less liquid current assets. It focuses on the company ability to meet up short-term obligation with its most liquid current assets. Company with asset test ratio less than 1 will not be able to pay its immediate obligation, and therefore they should be looked at with a caution. From the above calculation, both asset test ratio for EcoWorld and Gamuda are higher than the industry average. These indicate that both companies will be able to pay their debt on time. But the ratio for Gamuda of 1.88 times is higher than EcoWorld ratio, which is 1.1 times. Since the Gamuda Berhad ratio is higher than EcoWorld, we can say that Gamuda can pay their obligation faster than EcoWorld. Number two is efficiency. There is four ways to find efficiency. Number one is inventory turnover ratio. Number two, average collection period. Number three, non-current asset turnover. And number four, total asset turnover. Inventory turnover ratio measure how many times a company inventory is sold and replaced over a period. A higher inventory turnover ratio indicates efficient inventory management, meaning the company is effectively converting inventory into sales. From the above calculation, Gamuda Berhad ratio, which is 9.9 times more than the industry average, while eco-rate development ratio is 1.71 times less than industry average ratio. The high number of ratio on Gamuda Berhad indicate the effectiveness of the company in managing their inventory, while the low number ratio of eco-rate shows the company poor sales performance, or they are overstocking, or they had overstocking issue. Next is average collection period. Average collection period measure the average number of days it takes for a company to collect payment from a customer after sale. The shorter the average collection period, the faster the debtor are paying their account, and therefore effective, the more efficient the company is in debtor collection. From the above calculation, both average collection period for EcoWorld and Gamuda Berhad are higher than the industry average. Gamuda Berhad ratio, which is 62.89 days, is shorter than the EcoWorld development ratio, which is 99.84 days. EcoWorld ratio is much higher than the industry average of 25.5 days. Two high ratio indicate potential issue with credit policy or customer payment dates or payment delays. Hence, we can say that Gamuda Berhad is better than EcoRate at managing their debt collection period since their ratio is lesser. Next is non-current asset turnover. Non-current asset measure how effectively a company use its long-term asset to generate sale. High ratio indicate efficient use of non-current asset, and low ratio indicate underutilization of long-term asset. From the above calculation, both non-current asset turnover for EcoWorld and Gabuna Berhad is less than the industry average. Even though the ratio for Gabuna Berhad, which is 0.56 times, is higher than EcoWorld ratio, which is 0.39 times, their ratio still has a huge difference from industry average. Hence, we can say both Gamuda and EcoWorld are not effectively managing their long-term asset in generating sales. Next is total asset turnover. Total asset turnover measure how effectively a company uses all of its assets to generate sale. This ratio also provides an overview of asset utilization. So, the difference between total asset and non-current asset turnover is non-current asset only use long-term asset, Why? Total asset use both current and non-current assets. Here I continue. From the above calculation, both total asset turnover of EcoWorld and Gabuna Berhad is less than the industry average. Even though the ratio for Gabuna Berhad, which is 0.35 times, is higher than the EcoWorld ratio, which is 0.25 times. Both companies should increase their sale or dispose some of their assets. Since a lower ratio than the industry average indicate that the company actually not efficiently use their asset, or there are excessive investment in assets that are related to sales.
Debt ratio is a tool of financial ratio that measures the company leverage and is interpreted as the proportion of company's assets that are financed by debt. The higher ratio means the company's assets are funded by debt and are heavy liabilities more than assets. For the EcoWorld development, the company achieved a debt ratio of 0.46 times, while the Gamuda Berhad, the company earned a debt ratio less than EcoWorld development, which is 0.41 times. The ratio shows that the Gamuda Berhad company has better management in handling their assets than the EcoWorld development. Second, debt to equity ratio. The formula for this is total debt divided by total equity. Debt to equity ratio indicates a company's debt relative to the number of owners invested that have been retained over time. They are also important as a financial metric to the stability of a company. The lower the ratio is, the better, as it indicates the company is mature and has accumulated a lot of money over the years. However, too low a ratio can be a sign of resource allocation that is not optimal. For eco development, it earned 0.87 times, however, Gamuda Berhad earned 0.7 times. Next, time interest earn ratio. The formula for this ratio is earning before interest and tax divided by interest. Time interest earn ratio is a solvency metric that has been used by creditors or even investors to recognize a company's ability to cover the interest owed by debt obligations. From investors and creditors' perspective, a company with a time interest earn ratio greater than 2.5 is considered as acceptable risk. Another number below 2.5 will be considered a much higher risk for bankruptcy. For EcoWorld Development Company, the time interest earn ratio is 2.2, which is the lower from 2.5. For Gamuda Berhad, the time interest rate is 9.1, which is greater than EcoWorld Development. Hence, Gamuda Berhad is more obligated in paying its debt as it has higher times interest earn ratio than EcoWorld Development Company. Last, for the leverage is equity multiplier. The formula is total asset divided by total equity. The equity multiplier is also known as the financial leverage ratio. An equity multiplier is an indicator to measure the portion of a company's asset that is used from owner's equity rather than debt. It can be indicated that the higher the equity multiplier, it means the higher the amount of debt to finance assets. The better indication is when the equity multiplier is lower. For EcoWorld Development, the company earned 1.87 times, while the Gamuda Berhad company, the company has a value of 1.7 times for equity multiplier. This shows that the Gamuda Berhad company is having a better equity multiplier as they are more stabilized and have lower financial leverage or equity multiplier than the EcoWorld Development company. Next, there is 5 items under profitability. First, gross profit margin. The formula is sales minus cost of goods sold and divided by sales. When comparing the gross profit margins of EcoWorld Development and Gamuda Berhad, it becomes evident that Gamuda Berhad is performing more efficiently. EcoWorld Development has a gross profit margin of 0.65 times, whereas Gamuda Berhad boasts a higher margin of 0.97 times. This indicates that Gamuda Berhad is better at converting its revenue into gross profit compared to EcoWorld Development. The higher gross profit margin of Gamuda Berhad suggests greater profitability, assuming other financial factors like operating expenses and net profit margins are similar for both companies. Overall, Gamuda Berhad's superior gross profit margin reflects greater efficiency in its core operation. Next is net profit margin. The formula for this is net income divided by sales. When comparing the net profit margins of EcoWorld Development and Gamuda Berhad, it becomes clear that Gamuda Berhad has a distinct advantage. EcoWorld Development has a net profit margin of 0.11 times, while Gamuda Berhad has a significantly higher margin of 0.39 times. This substantial difference indicates that Gamuda Berhad is much more effective at converting its revenue into net profit compared to EcoWorld Development. The higher net profit margin of Gamuda Berhad suggests a greater overall profitability and efficiency in managing its costs and expenses. For eco-development, this disparity may highlight the need for improved cost control measures or better revenue management strategies. Next is operating profit margin. The formula for this is earning before interest and tax divided by sales. When comparing the operating profit margins of Eco Development and Kemudah Berhad, the efficiency and profitability of Kemudah Berhad are notably superior. Eco Development has an operating profit margin of 0.057 times and Kemudah Berhad has an margin of 1.104 times. A higher operating profit margin suggests that Kemudah Berhad excels in managing its operating expenses and generating profit from its core business operation. For EcoWorld development, the significantly lower operating profit margin may indicate the need for better cost control measures or more efficient operational strategies. Next one is return on investment, which is ROA. The formula ROA is net income divided by total asset. When comparing the return on asset of EcoWorld Development and Kemudah Berhad has a more favorable performance. EcoWorld Development has a return on asset of 0.064 times and Kemudah Berhad have 0.12 times. This indicates that Kemudah Berhad is nearly twice as effective at utilizing its assets to generate profit compared to EcoWorld Development. The higher ROA suggests that Kemudah Berhad manage its assets more efficiently and achieve better profitability. For EcoWorld Development, the lower ROA may signal a need for more effective asset management or strategic investment to enhance returns. Last one is return on equity. For formula for this is net income divided by total equity. When comparing the return on equity of EcoWorld Development and Kemudah Berhad, it is evident that Kemudah Berhad demonstrates a stronger financial performance. EcoWorld Development has an ROE of 0.12 times, while Kemudah Berhad has higher ROE of 0.33 times. This substantial difference indicates that Kemudah Berhad is more effective at generating profit from its shareholders' equity compared to EcoWorld Development. The higher ROE suggests that Kemudah Berhad is better at utilizing its equity base to produce earnings, reflecting a more efficient management and a higher rate of returns for its investors.
Next, we go to the price earning ratio in market ratio. In 2023, the price earning ratio for EcoWorld Development Berhad and Kemudah Berhad indicates how much investors are willing to pay for each unit of earning generated by these companies. For EcoWorld Development, the price earning ratio is 2.17 times, meaning investors are willing to pay 2 ringgit 17 cent for every 1 ringgit of earnings. This reflects a moderate level of confidence in EcoWorld Development future profitability and growth prospect. In contrast, the price to earning ratio for Kemudah Berhad is stated in the financial statement, making it easy for us to claim the PE ratio without having to the calculation. Kemudah Berhad has a significantly higher price earning ratio of 6.15 times, indicating that investors are willing to pay 6 ringgit 15 cent for every 1 ringgit of earning. This suggests a stronger investor confidence and higher expectation for future growth and profitability compared to EcoWorld Development. The higher PE ratio for Kemudah Berhad implies that investors see greater potential for future earning growth, whereas the lower ratio for EcoWorld Development may suggest more conservation growth expectation or perceived risk. So we go through the price sales in market ratio. In 2023, the price sales ratio for EcoWorld Development and Kemudah Berhad provides insight into how much investors are willing to pay for each unit of 10 exponent negative 4 times, indicating that investors are willing to pay a very small fraction of RM1 for each 1 ringgit of sales. This suggests that the market has a conservative valuation of the company's sales revenue, possibly due to lower expected growth or higher perceived risk. On the other hand, Kemudah Berhad price sales ratio is 3.20 exponent negative 4 times, which is even lower than Eco World Development. This implies that investors are even more cautious about the value of Gamuda Berhad's sales revenue. The lower prices ratio for Gamuda Berhad indicates the market is paying less for each 1 ringgit of sales, reflecting potentially greater concerns about the company's ability to generate future sales growth, a higher perceived risk associated with its revenue stream. Overall, both companies have low prices ratio, but Gamuda Berhad's lower ratio suggests a more conservative market valuation compared to Eco World Development Group Berhad.
Okay, we will be conducting a SWOT analysis of two prominent companies in the property development and construction sector, EcoWorld Development and Gamuda Berhad. We will be delve into their financial ratio to gain insight into their strength, weakness, opportunity, and threats. Let's begin with an introduction to both companies. First, EcoWorld Development is well-known Malaysian property developer. They are recognized for their innovative residential and commercial projects that cater to modern urban lifestyle. We'll be analyzing their financial performance and strategic position to understand their potential for growth and profitability. Second one is Gamuda Berhad, is leading construction and property development companies in Malaysia. They have strong reputation for large-scale infrastructure project and engineering expertise. Second one is Gamuda Berhad, is leading construction and property development company in Malaysia that have strong reputation for large-scale infrastructure project and engineering expertise. Our analysis will focus on their financial health and strategic opportunities to provide a comprehensive view of their current and future prospects. Let's start with Eco Development. First, the strength of EcoWorld Development based on the financial ratio. Certainly, one of the key strengths of EcoWorld Development is their gross profit margin of 65%. Their high margin indicates efficient management of production costs relative to sales. It shows that the company retains a significant portion of its revenue as profit after accounting for the cost of goods sold. Another strength is the return on equity or ROE of 12%, which reflects the company's ability to generate a good return on shareholders' equity, making it attractive to investors. Additionally, their debt ratio of 0.46 times suggests a balanced use of debt to finance operations, indicating moderate financial risk. Those are impressive strengths. However, no company is without its weakness. Next one, the weakness of EcoWorld Development. One notable weakness is the time interest earn ratio or TIE of 2.2. This ratio indicates that EcoWorld Development earned just over twice its interest obligation, suggesting limited ability to cover interest expenses with current earnings. Another weakness is their operating profit margin of 5.7%, which is relatively low and indicates potential inefficiency in managing operational costs. Lastly, the net profit margin of 11% shows that only a small portion of revenue translates into profit after all expenses, suggesting room for improvement in overall profitability. Now, let's move on to the opportunities for eco-world development. The strength of Gamuda Berhad. Of course, Gamuda Berhad has several key strengths. First, the time interest earn ratio or TIE of 9.1 indicates a strong ability to cover interest expenses with earning reflecting robust financial health. Their gross profit margin of 97% is exceptionally high, demonstrating effective cost control and substantial profitability. Additionally, the net profit margin of 39% indicate high efficiency in converting sales into profit, reflecting strong overall profitability. Lastly, their return on equity or ROE of 33% shows a very effective use of equity capital, generating high returns for shareholders. Next, the weakness. Gamuda Berhad has a few notable weaknesses. The debt-equity ratio of 0.7 times indicates a higher reliance on debt financing compared to equity, increasing financial risk. Additionally, their debt ratio of 0.41 times, while lower than eco-world development, still reflects considerable leverage. And lastly, their equity multiplier of 1.7 times indicates moderate financial leverage, suggesting a significant use of debt relative to equity. So what opportunities does Gamuda Berhad have? Gamuda Berhad has opportunities for strategic investment and international expansion. They can leverage their strong financial position to invest in high-growth sector and strategic projects. Expanding into international market can diversify revenue stream and reduce dependency on the domestic market, enhancing growth prospect and mitigating local economic risk. And finally, what threats do they face? Gamuda Berhad threats from regulatory risk and interest rate fluctuation, change in government policies and regulation in the construction sector can impact operational costs and profitability. Additionally, increase in interest rate can raise borrowing costs, affecting profitability, giving their reliance on debt financing. To conclude, EcoWorld shows strength in cost management and equity returns, but need to address operational efficiency and debt management. Gamuda Berhad exhibits strong profitability and financial health, but must carefully manage regulatory risks and debt levels. Both companies have opportunities for growth and need to negative market volatility and competition to achieve sustainable growth and financial stability. This concludes our SWOT analysis report presentation. So thank you so much.
So based on the question, our opinion for the future generation is for Gamuda Berhad demonstrates strong liquidity with high current and asset tax ratios, indicating its ability to meet short-term obligation efficiently. Its high gross, net, and operating profit margins suggest excellent profitability and operational efficiency. The significantly high PE and PS ratios reflect market confidence in future growth. With a strong return on assets and equity, Gamuda is well positioned for future growth and efficiency in generating returns. As for Eco-World Development Berhad, Eco-World Development, while also performing well in liquidity metrics, shows lower profitability margins compared to Gamuda Berhad. Its lower return on assets and equity indicates less efficient utilizations of its resources. However, the decrease in the PE ratio and slight increase in the PS ratio show a cautious yet positive market outlook. To improve future growth and efficiency, EcoWorld needs to enhance cost management and strategic asset utilization. So for the next conclusion is ability to grow and generate returns. So we will go one by one. So first is liquidity. Gamuda BHD, higher current and asset ratios indicate better liquidity management. This suggests that Gamuda can more easily meet its short-term obligations compared to EcoWorld. High liquidity is a positive sign for creditors and investors, as it implies a lower risk of financial distress. Second, we go to the profitability. Gamuda BHD excels in profitability metrics with higher gross net and operating profit margins. These margins indicate that Gamuda is more efficient in converting revenue into profit. Higher profitability suggests that the company has better control over its costs and expenses, which is crucial for long-term sustainability and growth. So next is return ratios. Gamuda BHD outperforms EcoWorld in both return on assets ROA and return on equity ROE. This highlights that Gamuda is better at utilizing its asset and equity to generate profit. Effective asset and equity utilization is indicative of strong management and operational efficiency. And lastly is debt management. Both companies have reasonable debt ratios. However, Gamuda lower equity multiplier indicates less reliance on debt to finance its assets, which can be viewed as a more stable and less risky financial strategy. Additionally, Gamuda higher times interest earn ratio signifies stronger solvency. This ratio measures the company's ability to cover its interest obligations, and a higher ratio suggests a lower risk of default, making Gamuda more attractive to investors and creditors. So lastly, recommendation for BOD. So for Gamuda BHD, investment in Gamuda is recommended due to its superior financial health, efficiency, operations, and stronger profitability indicators. Gamuda's ability to manage liquidity, generate high profit margins, and effectively utilize assets and equity positions is a more attractive investment for future growth and returns. As for EcoWorld development, focusing on improving cost management could enhance profit margins. Better management and strategic investment in assets are needed to improve ROA. Additionally, maintaining a balanced approach to debt will ensure long-term financial stability. Therefore, while EcoWorld has potential, Gamuda current performance metrics make it a more compelling investment choice for future growth and return generations. So in conclusion, Gamuda financial metrics indicate better performance and growth potentials. EcoWorld development has areas for improvement but also shows positive aspects. So we prefer to choose Gamuda Berhad as for the recommendation for BOD.